Yeah, welcome to the third version of this welcome to the third version, sorry about that. Welcome to the third volume of video number 3 or recording number 3 of this ongoing analysis of all the companies in NGX, Nigerian Exchange Group, formerly known as Nigerian Stock Exchange. We are on a mission to analyze all the companies that met this criteria. Number 1, positive cash flow, for at least for the past 7 years, 3 years plus. Positive return on investment for the past 7 years, and that has free float of at least 20%. So, like we formerly said, we have up to 151 companies in the exchange. When we subject it to this criteria, we are left with 29 companies. So this is the third company we are analyzing their fundamentals. We've analyzed number 1, which was First Holdco. The video is here, you can go back and watch, from 2020 to 2024. Why are we not putting 2025? Because the full year result of 2025 is not yet audited. When it is audited, we add it to the radar. So this helps you to see how their books have failed for these past 5 years, and it can help you add to your investment making decision. Because after these fundamentals, the next thing to look at is go to the annual reports, do your valuation, look at technical levels, find out if it is overvalued or undervalued through your valuation. Then you look at your technical levels and start looking for where demand is in the chart and load it up and invest. So this is for educational purpose, to help you guide you as you are making your research. So we are not recommending any of these stocks, what is to add to your research purpose. So with this out of the way, so the company for the day is Nestle. So if you know Nestle is under Nigeria, it's under consumer goods, some detergent, stuff like that, just consumer goods, like we normally do. So number 1, we dive into their income statement. Remember, for the record, their return on capital investment for the past 7 years on the average has been over 33%. They have a free cash flow of over, on the average for the past 3 years, a free cash flow of over 52 billion naira, so which is pretty nice. So that's the thing. Then free float of over 20%. So with that, let's dive into the number. So when you come to the income statement, because it's a manufacturing business, so you just look at the margin, almost similar to what happened with Dangote, Dan Sugar, because it's a manufacturing business. So you look at the 3 margins: the gross margin, the operating margin, and the net margin. So that's what you look at in a manufacturing business. So for the gross margin, you can always average it out. For the past 5 years, we have already sorted it so that we dive. So this is what the gross margin. But let's look at what the revenue looks like though on a trend. Hold on a sec. So something happened. So it's a pretty nice margin, average of over 37% for the past 5 years. Then the next thing to look at is the operating margin. So when you come to the operating margin, you also see it, which is this. You derive it by doing the maths here. So on the average, you can see that the operating margin is over roughly 21%, which is pretty nice, way great. Then the last thing to look at is the net margin, when you have subtracted all the expenses and stuff like that. But you look at the operating net margin, you look at it. So the net margin, if you do the average of 5 years, it is at 0. Not up to 1%, 0.86. But there is something that happened. You can see that in 2020, the operating margin was over 13.6%. 11.37%, 10.95%. But in 2023 and 2024, it was now negative 14.5 and negative 11.5. So when you look at this in finance, it's called outlier. So that means something must have happened. So if you dig deep, it was this during this 23-24 year that the CBN floated the naira. And remember, they also have the dollar books and dollar obligations. So that affected them. So they took a double whammy from the exchange rate, which you can see from here. The unrealized gains were lost on foreign exchange. So they had two negative years. So it affected it in 2014, 2023, 2024. So in such situation, what you can do, you can strip out. So that is why if you go to their technical chart, you see that within this year, those businesses took manufacturing business, consumer goods business, almost all of them took a beat because of that. Even you can look at the Dangote sugar we analyzed, they had the same thing because they import a lot. So what you can do, you can strip out this year and just look at these 3 years. So with this, stripping out that outlier, you can see that their net margin is over 12% on the average. So it's pretty nice. So with this, you can say that the income statement they have a profitable income statement. Is this only one of the ways to make decision? No, this is one way. You can now say, okay, now let's look at the balance sheet. And even the income statement is not great. You know that you just analyze the balance sheet for analyzing sake. You can just stop here and know that the business is not profitable. But since the business is profitable, you can now go over to the balance sheet to see what their debt level looks like. And before then, you can look at here also, you can see what their earnings per share is like. So you can see that 2020, they have over 14 bars. Pretty nice. Basic earning per share, 49 points. So 50.51, 50.51, 61.77, and because of that negative FS loss, it affected. They had two negative earnings per share here, so which you can always strip out because you know the cost. It's not because the business was performing bad, but it's because of policy. Had it been the business is declining, you don't strip it out now, you factor it in and know that sales are coming down, no more demand and stuff like that, internal problem, then you start knowing that that business is heading south. So so let's look at what their balance sheet looks like and see what their debt level and the leverage level, and if they have a positive earning and stuff like that. So if you enjoyed the video, comment, like, share, and ask questions. Remember to follow us on X, YouTube, reach out to us. On X, we are there every day, post updating you with nuggets. So if you're not following on X, you are missing out. The link is all in the description. Use it, follow us, and let's go to the balance sheet. So okay, this is the second part of the analysis where we look at the balance sheet to see what their debt level looks like, how solvent is the business, how leveraged are they. Since it's also a manufacturing business, you have to see if they are holding inventory, what part of their inventory is their current asset and stuff like that. So let's go to it. So the first metric we use to evaluate this balance sheet is to see what their current ratio looks like. So this ratio helps you to know how solvent the business, how liquid solid the business is. That is, can they meet their short-term obligations? So, and the rule is once the ratio on the average is below 1, it's not great, but it's above 1, that means they can meet their obligation one-on-one. So from 2020 to 2024, the average of this is over 1.0808. So great. So they are. So on the liquidity side, when the business is liquid, you can tick it off. Then the second one is to look at their debt to equity, like how leveraged is the business. The rule is any debt that is above 2%, it means the business is highly leveraged. Is it a red flag? No, but it's also a sign. The lower the leverage, the better. But sometimes some growth-related business take on more debt and stuff like that. So let's look at it for the past 5. You can find out something that from 2023-2024, there is a negative debt to equity ratio because of that FX devaluation that affected the return earning part of the business, which we are going to show you. So we can strip that out and use 3 years, which is over. So their debt to equity ratio is over, on the average 11%. So it's a highly leveraged business. So highly leveraged. Then let's look at their debt to asset as part of their asset, which part of the, if you are weighing the debt they have with their asset, so which part of their asset is debt or something of that nature. So the rule is if it is over 60%, that means the business has more debt than asset. If you look at it, you don't need to be told. The average is over 90. So it's a highly leveraged debt structured business. Then the next one is the inventory they have. Inventory is part of current asset. So how many percentage of the inventory is part of the current asset? So now, if it's over 60%, that means they are holding so much inventory. So let's look at it. So the average is over 33%, which is pretty nice. So it's not, their inventory is not a major part of their assets, current assets. So let's look at what the last thing we need to look at before we now finally summarize, which you can run with the analysis and continue your research. Let's look at the total equity. Let's look at the equity of the business. You can see that in 2023, 2024, that return, that FS loss affected it. So they had a negative shareholder fund in 2023 and 2024. So but this year, some of the results we have seen, which is not fully audited, they have gradually started exiting this to turn it positive. So this only couldn't have been your reason for not investing or furthering the analysis, because it's just a shock, it's just an outlier which can always trip out. But for this balance sheet, the concern is that the debt level of the business is on a high side. So if the business is not making revenue substantially, then any shock can affect the business. So you look at it, make your further research and add it to your analysis. So till then we see in the next series we are going to look at this MTN Nigeria in the next analysis, which will be video number 4 in this analysis until you get to the 29. Till then, like, share, subscribe, and peace.